Namaskaram, na peru Jagan, qualified chartered accountant. So let us, previous class we have discussed about the AS3 accounting for investment. Previous class we have discussed about the introduction as well as scope, as well as investment definitions, as well as fair value definitions, as well as X interest rate definition, as well as X cum interest definition. Next, we will discuss about the types of investment, the current investments, the long-term investments. May I know what is the definition of current investment? Readily realizable for sale and not to hold for more than 12 months. If these two conditions are satisfied, then it should be treated as a current investment. So long-term investment means other than current investments. Up to this we have completed, and again, so with respect to how to value cost, initial recognition, recognize at the cost. So for cost also, some items you have to add. The first topic we have discussed about, that is brokerage charges, duties, is to be added to the cost of acquisition of shares or debentures, whatever maybe it is. And the second, now today the most important topic is right shares. So right shares, what is meant by right shares? The option given to a shareholder to purchase the shares below the market price. This is the definition of right shares. So now, so why the right shares have been come into the concept? Because the company requires an amount of capital, they can go for the public offer, so they can get the money at higher than the market price. Then why the right shares are issuing? So let us go to an example, then we will understand why right shares are come into picture. Suppose there is an investor A, B, C, D. Total are 100 shares. So with respect to A is holding 52 shares, B is holding 24 shares, C is holding 12 shares. So how much completed? 88, and C is holding also 12 shares. So total 100 shares. May I know the percentage of the A is holding? So A is holding 52%, B is holding 24%, C is holding 12%, as well as D is holding for 12%. Or suppose company went into an public offer in this, at 50 shares they have issued to public. So E has purchased 50 shares. So may I know, rewrite the shares. So 52, 24, 12, 12, whereas E comes into the picture, new shareholder. He has purchased the 50 shares. Now can you calculate the percentage shareholding pattern of the equity shareholders? Yes. So 150. So what happened? The shareholding pattern of all the shareholders have been diluted. So this will be a problem for the shareholders. And then if you say right shares, for suppose for every one share, for every two shares, one right will be given, which shall be purchased at the lower of market price. If you take, so right shares has given. So for 52 means 26 shares he will receive, 12 shares here he will receive, 6 shares he will receive. So he will receive 6 shares. Then you can calculate. So total shares after the right issue is, so you can get it this one. So now calculate the shareholding pattern after the right issue. Of course. So let's see. The shareholding pattern before the right issue and after the right issue is the same. The main reason behind the issue of right share is not to dilute the shareholding pattern of an equity shareholders. This is called. Now we will discuss about what will be the impact of issue of right shares on cost of the equity shares. Now For this also, the equity sets are broadly classified into two types. One is X right, cum right basis. What is the nana? X right as well as cum right. If you know these two definitions, then we will understand the accounting as well as value of an investment after the right issue, before the right issue. So let us, X right issue means, for suppose X is a shareholder who is purchasing the shares on 1/4/2024. So on that day, the company said you don't have an option to purchase the right shares after 6 months. That means we are going to issue shares after 6 months, right shares, but you don't have an option to exercise that one. That is called X right basis. Whereas cum right basis means he has an option after 6 months, he has an option to purchase the right shares. So if X right means the price will be higher, so there is no impact. Whereas cum right price means the price may be higher. It includes the cost of an equity as well as cost of right shares. So now we will discuss X right price ka valuation. So what are the options available with the shareholders when the company given a right shares? Now the option is he may purchase the right shares, he may sell he may cancel, then he may sell that right to another person. If he purchases, then nothing will be happen. Then the cost of purchase of that X right shares will be added to the cost of investment. Yes, sir, Nana? Yes, sir. So we will directly add to the investment value. So again, with respect to if you cancel, there is no inflow, there is no outflow. So nothing will be an impact. With respect to sales, the accounting standard AS13 as per para 13, whenever the right has been sold to some other person with a price X, then it should be directly transferred to P&L in case of X right only. Remember my point? If you sell the right shares, rights, then as per para 13 of the accounting standard 13, it will be directly transferred to P&L. Remember my point? It will be directly transferred to P&L. Okay, Nana? Now we'll discuss about cum right basis. There also three options will be possible. So for purchase, same concept, directly add to the investment value. If you cancel the right shares, then there is no impact whenever they are selling. So whenever they are selling, the accounting treatment will be different. So before going to the concept, let me see an example, Nana. Okay. So A has purchased cum right shares. How many, Nana? 1000 shares. How much? For 100 rupees. What is the investment value? Sorry, investment value will be 1 lakh rupees. So after 6 months, the company given an offer to purchase the company given an offer of right shares. How much? 1:10. So how many shares? At a price of 12 rupees. At a price of 50 rupees, sorry. 50 rupees. So after the right issue, the share price became 75. Okay, no. Are you understanding the concept? So now the three options I said. If he purchased the share, then nothing will be happen. Then investment value will be directly added 50 rupees into 50. So if he purchased, this is all. Therefore 1,05,000 will be the. So 1,05,000 will be my total investment value. But suppose if he sold the right to some other person at a price of 20 rupees. So 20 rupees. What will be the income proceeds that he will receive? Each right he sold for 20 rupees. He will receive 2000 rupees. He will receive 2000 rupees. So now, what will be the decrease in value of shares after the right issue? If he is not opted, the price will become 50 rupees. Then, so 75,000. Then what will be the difference amount here? 1 lakh minus 75,000. Sorry. 1 lakh minus 75,000. That is called 25,000 rupees. Here I will change an example, Nana. He sold that right issue to 30 rupees. So, I want to tell clearly the concept, but I'm missing the logic here. You take 1:1. 1:1 you have to take, Nana. For every one set, they will give 1:1. So now this is 1000 sets, it became 1000 sets. So now it became 1,50,000. Here also you can make 1000 rupees. So 30,000 will be my net sale proceedings. Then the Ind AS 13, an exception to this rule, it clearly said that up to 25,000 you should reduce from the, you should be credited to the investment account. Understood my point? 25,000 should be added to the investment account, whereas remaining 5,000 you should be transferred to the P&L. So by using this concept, I will conclude that if come right option is given to the shareholders, then up to the decrease in investment value after the right issue, it will be transferred to, it will be added to the investment. Then the remaining amounts will be transferred to the P&L. Have you understood this concept? Yes, sir. So the overall scenario, I will say that right issue, if we purchase, then it will be directly added to the cost. If we cancel, no accounting treatment because there is no inflow as well as there is no outflow. However, if he sell, whether he is purchased X right basis or come right basis. If he purchased X right basis, then it should be directly transferred to the P&L account. Whereas he purchased come right basis up to the decrease in value after the right issue, it should be added to the value of investment and remaining should be transferred to the P&L. Are you understood this concept? Yes, sir. Yes, sir. Okay. Thank you for giving this opportunity. Please subscribe my channel for other videos. Thank you. Bye.